Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Mark Marex, Head of Index Research Americas at Nasdaq, as well as Jason Chen, Senior Research Analyst at Xtrackers ETFs by DWS. We're here to discuss how investors should be thinking about the impact of inflation, currencies, and yield in their portfolios. Of course, we'll dig into some AI as well. It is great to have the both of you with us. Welcome to Trade Talks. Jason, let's kick it off with you. In the past 3 years, there seems to be resurgence in inflation across economies and, of course, around the world. Is inflation here to stay? And if so, what are the impacts? How should investors manage that within their portfolios?
Sure. Yeah, inflation is here to stay, perhaps not in the same way it was in 2022, for example. Really, what we saw at that point was you had the sort of intersection of post-COVID related supply chain. But also, I think what gets a little bit lost in that narrative is the fact that we've actually been seeing deglobalization or a slowdown in globalization really since around the financial crisis, right? And so the reason why we think inflation is going to be more persistent going forward than it was, call it between 2008 and 2022, is in large part because we've had this nationalistic protectionist policy that's been playing out. And so in our view, and I think in the view of a lot of investors, inflation is going to be more persistent than it has been. And that has really meaningful impacts for investors. If you were in an environment where the Fed could just buy more bonds every single time something bad happened, then you could simply own bonds to protect against stocks, right? So a stock bond portfolio was properly diversified against growth-related risks. If you enter a macroeconomic regime that is not only growth, it's perhaps more growth dominated than inflation, but inflation is also a risk. Bonds might not work in the environment where inflation is the problem, right? And so I think what you're seeing with a lot of investors now is kind of rethinking what diversification means. So in an adverse scenario, our bonds can protect. It depends. If it's growth, then yes. If it's inflation, then you have to start thinking about strategically how to build a portfolio that can kind of be resilient in that environment. And it's going to increasingly include real assets. Think about real estate, commodities, natural resource equities. And so I think it's going to have to require people to rethink the way they invest strategically, because now inflation might not be the biggest issue, but it is something to think about in a strategic way going forward.
Yeah, and Mark, I'm going to ask you the question, but from the perspective of a corporate, because of course, inflation is a concern for them and the impact to its consumers and throughout the supply chain as well. What are your thoughts? You think inflation's here to stay, and how are companies thinking about this?
Yeah, I mean, look, I think there's very little to argue there with what Jason said. In fact, we've talked about, I think, on a few of our other segments, Jill, this notion that, when you are in a world of deglobalization, or at least global deglobalization trends and a slowdown in deglobalization, coupled with the fact that, you've got a lot of other structural forces driving the cost of certain things much, much higher, especially in the US. You think about things like healthcare and education and housing, right, which have been big sticking points. This sort of mismatch, right, of a lot of people retiring and needing a lot of money to fund those obligations and not enough people coming into the workforce because the birth rates are declining, right? We've talked about how 20th century growth was a growing pie, leading to revenue growth across the board, across many different sectors, net income growth across many different sectors, and those disinflationary pressures from globalization. Very different environment in the 21st century. And we've talked about the importance of innovation as being the main source of providing growth, whether you're talking about the company level, at the country level, the economy level, or even the sector level. It's really finding a way to out innovate your competitors and bring something new to your target client base to help you grow as a company, which is where we've seen, the most impressive fundamental metrics. You think about, areas like tech and consumer discretionary, stuff that you get from the Nasdaq 100, among other products. Those are the areas where you see, I think, a lot of insulation against those inflationary pressures. Not to mention, a lot of these companies have great pricing power, which you just don't see in a lot of the sort of physical goods old economy type sectors as much.
Yeah, and Jason, there's also been a question recently around the US dollar and its place as the global reserve currency. How should investors think about currencies as part of their portfolios going forward?
Yeah, the dollar is a very complicated thing. I don't think anyone has figured it out. I mean, I try, but we certainly, you know, ask that question every single day. In terms of dollar dominance, there you are seeing outflows. You are seeing more allocation to other developed economies and emerging economies as well. So there is a bit of a pivot away from the dollar as the dominant currency. That being said, I think there's a little bit of an exaggeration of the US dollar losing its place as a reserve currency, right? If you think about there's a saying that is used in other avenues that is it's the best house in a bad neighborhood. And that's kind of the same way that I think about the dollar and the US economy. Is if you compare to other developed economies, the US has, as Mark mentioned, the demographics aren't good, but they're better than a lot of other places. If you look at emerging markets, we have more, more stable capital. We have better governance. We have lower interest rates, more stability, less inflation. And even if you look at China, for example, they tried to increase their standing in the SDR basket in 2015, and that didn't necessarily work because investors want free floating capital. They don't want to be constrained by regulations and governance in that way. And so I do think the US dollar is going to continue to be dominant, perhaps not as much as it was before. I think what's really interesting, though, for investors is, and this is on the back of this concept that currencies are not an investment. Currencies long term don't really return you anything because they're zero sum, right? For me to make money, somebody in Europe has to lose money on a persistent basis. And there's not really any risk premium there. There's no reason why that should happen. And so I do think what's really interesting is when people are buying international equities, they're buying the currency and they're buying the equity. That currency, whether the dollar is the reserve currency or it's not, is still an uncompensated risk. And so I think what we like to think about it and try to advocate for a lot with investors who are buying international equities is think about the currency risk separately from the equity risk and think about whether it's something that you want. And in many cases, if you're not getting compensated for it, it actually makes sense to remove it from the portfolios. To take the equity to accrue the value that Mark had mentioned in terms of profitability and free cash flow generation, and then remove a component of risk that's not necessarily going to pay you anything over the long term.
Yeah, that's an interesting point that you make. And Mark, the fact of the matter is, too, is the liquidity that the dollar offers. And for all intents and purposes, global trade is really facilitated for the most part with the dollar as it stands right now.
Yeah, I mean, look, it's all relative at the end of the day. To sum up what Jason was saying, it's relative to what? What is the alternative to supplant the dollar in terms of trade flows, in terms of reserve holdings these days? There just isn't one. And to the extent that that process has gotten going, and I think it is highly debatable, whether it has gotten going in some sort of meaningful, sustainable way, that's a multi-decade long process that takes to play out at a minimum, right? And so, what we kind of hear from some of the clients and investors that we talk to here at Nasdaq day to day is a lot of this question of like, hey, is international going to start to outperform US? Should we start to look at, for example, international dividend achievers or international technology companies versus US companies, which have been outperforming and dominant for so long? And it's easy to kind of, point to history and say, look, these things do go in multi-year cycles, and we're very, very long into the current US cycle of outperformance. And a lot of that has been tied to the dollar being really strong, right? Because it goes back to really, really solid macro fundamentals in the US, at least relative to the rest of the world in terms of things like growth and innovation. The answer is it's nobody knows, I think is the real answer. Because, to the extent that the dollar weakens, right, that actually does help a lot of big global tech companies because a lot of their earnings are earned outside of the US, right? And so all of a sudden they're receiving more in dollar terms from all their international customers in Europe and Asia or wherever if the dollar tends to weaken. So in a very sort of concrete first order way, right, weakening dollar actually is kind of good for indexes and strategies that focus on large cap tech. And from the other perspective, right? It's the question of, again, can some of these areas outside the US that have been underperforming start to catch up in some of those areas of innovation, whether you're talking about AI or cyber or cloud or something else where the US has been dominant in now for 10, 15 years. Certainly China's trying to catch up in that, but they operate in a very different system, much more of a, closed economy system. And it's debatable, frankly, if that torch really can be passed over the coming years, as long as those technological trends that are so centrally tied to economic growth drivers right now, if those continue to be concentrated in the US, maybe that kind of puts a lid on how much the dollar weakens.
Yeah, and we'll get into some of those tech themes in just a moment. But Jason, I want to go back to bonds for a moment here. As markets have melted up and valuations have become more demanding, corporate bonds, high yield bonds in particular, they've seen their spreads move toward historically tight levels. How should investors think about allocating to high yield? And back to the currency question, is it a worthwhile strategic holding?
Yeah, so there is a lot of evidence that high yield in general is a very strong strategic allocation. A lot of the comments on high yield, I think, can also be made for equities, right? You have historically or near historical tights for equity risk premium, as you do with credit risk premium. In fact, I think in some cases you can argue that high yield strategically looks better because it has that fixed rate component, which is actually quite attractive, as treasury yields have moved much higher than where they were for the past 15 years, right? So I think strategically, even though the spreads are very tight, fundamentals are good for these companies in the same way they are for the equity, right? It's funding from the same subset of companies in some cases. And also the yields are quite attractive. Perhaps the spreads are not, but the yields are. I think one thing that that is a way to kind of pivot away from some of the credit risks that exist is to lean towards higher quality bonds. This is something that a lot of people do strategically, right? If you look at upper tier high yield, the risk-adjusted returns empirically are better than they are for broad high yield. And so this quality bias in general has benefited investors. So that is something to be thoughtful about if you are a little bit more wary of the market and the macro conditions. I think one thing that was quite interesting when I was doing work on high yield was, everyone kind of knows this after the financial crisis, is credit rating agencies aren't necessarily going to predict something in the future. They're kind of reactionary, right? They downgrade companies and countries after something has happened. And what I did back was I looked at every single bond in the ICE index since 1996, since it started. And I looked at every single downgrade. And on average, it was kind of surprising the magnitude, but the narrative was the same, is on average, in the 3 months prior to an actual downgrade, you saw spreads widen by nearly 600 basis points. And so it's basically saying what happens is, the market already knows that a bond is fundamentally impaired, and then the rating agency downgrades it after. And so I think when investors are thinking about this quality bias as a way to kind of, protect against some of the downside if something unforeseen happens, what they should be looking at is not necessarily the rating. They should be looking at the price or the yield or the spread, because that's just going to be a much more timely indicator of when the market understands that a bond is challenged before there's actually a checkbox next to it in terms of the downgrade.
Yeah. And Jason, I want to spend the last few minutes here talking about the key tech themes. AI, of course, is one of the hottest thematic topics across not only investing, but it's also transforming people's day-to-day lives. As the AI space evolves, how do you think the landscape will play out? Will there be winners, or will there be space for many companies to do well? What are some of those indicators that a company might lead in the AI race?
Yeah, I mean, it's a rapidly evolving theme. Mark has done a ton of research. I actually will probably reference some of it. Apologies, Mark, for stealing some of your thunder. I think what you can kind of take from evidence and technology playing out, not just AI, is a couple of dynamics that have been going on for multiple decades, right? One is the composition of the S&P. If you look at the 5 largest companies, it was over 80% tangible assets in 1975. 50 years ago, the majority was machinery, things that were physical, right? Now that number has completely flip-flopped, where more than 90% of that value is intangible. So the theme is intangible assets are winning out over time. intangible assets, think about intellectual property, R&D brand value. And the other thing, Mark and his team have this really interesting exhibit that looks at R&D by quartiles. And what you find is the top quartile R&D investors have dramatically outperformed in terms of financial performance. And so it's hard to say exactly the companies. I'll leave that to the fundamental equity experts. But this theme that you have to be a leader, you have to be spending, you have to be building that intangible asset base is something that I think is going to define AI as it evolves over the next decade or so.
Yeah. And Mark, I know exactly what research Jason is referring to because it is some of my favorite content that your team puts out there when you think about investing, whether it's CapEx, R&D growth, patent growth, as an example, and how we see that translate into a lot of these companies.
Yeah, yeah, and I think Jason hit it right on the head, and I think the really exciting thing about AI is we're almost kind of seeing this thesis play out in real time, right? Like we've been doing this research for several years now and kind of taking different views of it and drilling into R&D and really not trying to overly focus on the biggest companies because everybody knows they spend the most on R&D. We're talking about, close to $1 trillion of spending on R&D for something like the Nasdaq 100 on an annual basis these days. CapEx just on AI, right? This year about 350 billion, next year going to 400 billion, just among the top four, right? Microsoft, Google, Amazon, and Meta. So it's this tremendous concentration of spending, and we know those companies are doing well, but turns out if you normalize it, if you normalize R&D spending as a percent of sales, percent of revenue, you get kind of the same results, which is that top quartile, right? The highest reinvestment rate that you get across companies in terms of plowing money back from their top line revenues into R&D spending. Those are companies that see 3 to 4x sales growth over a 10 or 15-year period post financial crisis versus the rest of the world in for example the global large cap space. Those are the companies that see 3 to 4 times the price performance, right? And so you hear a lot of talk about like, is AI another bubble? Is it the next coming of the dot-com craze in the 1990s? And there might be some similarities, but I think it is at a very fundamental level very different because you don't have the same sort of outsized valuations. You have a ton of earnings growth and free cash flow growth powering a lot of these advancements in some of these companies' share prices. And it all goes back to ROI, right? Are they seeing ROI on these massive investments that they're making? And in a lot of cases, what we're seeing in recent earnings calls, again, whether you're talking about the Microsofts, the Googles, the Amazons of the world, or some of the smaller names, they're repeatedly saying, yes, we see the ROI. We can't keep up fast enough with the demand in terms of seeing the demand for AI services, inflect upwards. So that's what we're keeping an eye on, and that's the story for the foreseeable future.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.